Open a trading chart today and you are often bombarded by noise. Diagonal trend lines drawn on a whim, dozens of overlapping support levels, and lagging indicators that block the actual price data. It makes it difficult to see what the market is actually doing, often leading to inconsistent results. There is a different way to read the market. Instead of relying on subjective shapes, we can track the objective, unhideable footprints left behind by large financial institutions as they execute their massive orders. In this video, we are taking a completely blank canvas and building a professional multi-timeframe market map from the ground up. By constructing a clean structural chart, you shift your focus. You stop reacting to every random green or red candle and start executing against a specific spatial blueprint. Step 1 is identifying the raw market phase. Before you draw a single line, you have to determine what overall state the asset is currently in. This diagram shows the only 3 states a market can exist in. It is either in an uptrend, making higher highs and higher lows, a downtrend, making lower lows and lower highs, or it is in consolidation. That third state, consolidation, is frequently a trap for retail traders. When the market fails to break the highs and lows, large institutions are often building up orders. They can throw wicks above and below the range, triggering stop losses before the real move begins. This gives us our first strict structural rule. If a market is in a consolidation block, you wait. You need to see a definitive breakout before mapping a new trend. Identifying this macro phase first helps prevent you from getting caught in the false breakouts that occur within a ranging market. Once we confirm a clear trend exists, we build our foundation. For this, we use the 4-hour time frame. This is our major structure. On this 4-hour chart, we mark the major peaks and valleys of the trend using thick, bold horizontal lines. This clearly defines our highest highs and lowest lows. Precision is key here. If even a single wick breaks above our previous high, we consider that a confirmed structural break. The previous boundary is no longer the active high. Now we apply the core architectural concept of the chart, identifying strong or protected points versus weak or targeted points. In an uptrend, a strong low is the specific pivot point that generated the force to break the previous structure. The new peak created at the end of that push is your weak high. The logic follows institutional order flow. Large players enter at these strong lows, and they have an incentive to protect those zones. Conversely, they often drive price toward the weak highs to capture the liquidity that sits at those obvious peaks. By identifying these points, your chart shows you where the market is likely to hold and which levels it is likely to attack next. With our macro map set, we drop down to the execution layer on the 15-minute chart. It is important to keep those bold 4-hour lines visible. Without them, the 15-minute chart can look like random noise, making it easy to lose your sense of direction. As we zoom in, we see the internal waves happening between the 4-hour lines. While the 4-hour trend pulls back, the 15-minute chart will stair-step downward toward your protected major low. We are waiting for a trend change. This is the moment the 15-minute minor structure breaks upward, ending its pullback and sinking back up with the major 4-hour uptrend. This moment of multi-timeframe alignment acts as the trigger for your trade. The structure is now providing objective confirmation that the pullback is likely over. Isolating this minor structure within your major boundaries allows you to participate in macro moves while keeping your risk defined to the smaller time frame. However, we still need a way to determine when it is appropriate to start looking for that 15-minute alignment. We do this using a premium and discount range. Take a standard Fibonacci retracement tool and strip it down, clearing the default numbers until you are only left with the 0, the 0.5, and the 1. Draw this tool from your 4-hour strong low to the weak high. This divides the current range into a red zone on top and a green zone on the bottom. The top half is the premium zone, where price is relatively expensive. The bottom half is the discount zone, where price is relatively cheap. For long positions, the rule is simple. Wait for the price to dip into the green discount zone before you begin searching for that 15-minute trend change. This defines value based on the range itself. By using the PD range, you filter out premature entries and ensure you are buying at wholesale prices relative to the current trend. Compare the final chart to the mess of indicators we started with. We have replaced visual clutter with a systematic framework. These three pillars work together. The 4-hour major structure provides the direction. The PD range identifies the high-value location. And the 15-minute minor structure provides the entry trigger. To get comfortable with this, pick one asset and open the 4-hour chart. Map out the last month of price action using this top-down process. Using market structure helps replace guesswork with a repeatable system. You are no longer following a feeling. You are following an objective blueprint.